that comes with benefits like passive investing income, right? So you have a way to make a secondary income without the work, which I think is a huge advantage that really needs to be, something people listen to, because I think everyone every day is thinking, how can I make more money? Hey everybody, welcome back to another episode of Wealth Unfiltered. I'm Samantha Parinello. I'm your host, and I'm here joined by my resident guest expert, Chris Parinello. Welcome back.
Yeah, thanks. Happy to be here.
This week's topic, we are covering why investing beats saving. So this episode is geared towards first-time investors, young professionals, and anyone who feels paralyzed to start their investment journey. So many people have a negative connotation when it comes to money. They see their parents who live paycheck to paycheck, or they're frankly just not taught anything about finances. And today's episode is about breaking that mindset and changing into an investment mindset. So I want to get started by talking about what you probably know a little bit about, which is savings. So my first question is for you, Chris, and I wanted to discuss maybe some of the most known ways that people choose to save their money in different accounts.
Yeah, no, I think, most professionals, will utilize an IRA or a 401k. It's kind of what America went to as far as the main education on, if you're going to save, what's the easiest way you can do it? An employer match 401k or IRA. Many people, growing up, it's, you have a checking account, a savings account, which, there are for having liquidity, having like a money market account or a savings account that's getting you some small amount of interest, that's fine too. And usually it's, you want to have enough cash on hand to take advantage of opportunities and to protect your own downside risk. Things could go wrong, big home repair, send your kid to college, things like that you might need liquidity for. But for the most part, I think the line that you want to kind of teeter on is, what's the lowest amount of kind of cash savings that I need, and how much of my savings can I put to work for me?
Right. I would say that one common problem or myth is that you have to be rich, or you have to have some specific amount of money that people get in their mind in order to start their investment process. And I'd like us to help people shift that mindset to understand that there isn't a certain dollar amount you have to have. And it's never too young to begin your investment journey. So one thing that Chris and I absolutely do in our home is we have an 8-year-old little girl. And I would say probably for the last 2 years, we've already discussed with her what investing is like. When you ask her what she does or what we help her do with her money that she gets from helping her grandma with a garden, or for chores that she does, or soccer goals, or basketball wins, she tells you, oh, I put it to work for me.
Right.
And so at any age, you can really do that. And for us, I think it's just a testament to you're never too young, and it's never too early to start that process with your children, for yourself, especially as people get to the age of being, a young adult. That when you're 18 and you're going to college and all of a sudden you're about to go in debt, many people don't get to just write a check and say, okay, I'm paying for college. And those people should also be thinking about what's my next step after college? And not just on the trajectory of my career, but how will I have set myself up for success? Right? So I think this is helping people. This episode is really truly to help people understand different investment platforms, different ways that they can invest their money, and also why savings is just not it anymore. It's really truly, that mindset is not going to build you generational wealth. And our goal would really be to help people take that leap.
Yeah. And I think the argument is that, some people, like you mentioned, think, oh, well, when I make enough money, I will put some of it away. And the way that, people build wealth is by taking advantage of their time horizon. And every year that goes by that you're not putting money to work for you, you're losing the thing that you can't get back, which is time. Yeah. And that's why it's important. Like you brought up, even as recent as last night, she traded me 3 songs last night for 5 songs tonight. So she's like, you can get out of my room early and I'll go to bed and I won't cause any fights. but tomorrow there's a risk premium where I'm going to get 2 additional songs. And I took that deal because it's like, this is, win-win, right? She's learning, and it's things like that. Is people understand that simply saving your money without it earning any interest from you is a fool's errand. You're actually losing money because of inflation.
You actually just knocked exactly what I was thinking. Like you got it on the head. For me, what I wanted to ask you is, a lot of people think, well, I'm saving my money, so I'm at least not losing it. But I think that's also a myth. Inflation especially. So can you touch on that a bit?
Yeah, and traditionally, if you look at a historical chart of inflation in normal times, it usually tracks somewhere between 2 and 4%. That's right now the Fed is desperately trying to get back down to 2, but the only reason they're so desperately trying to get to 2 is because we had several years where it was very high, in the teens, depending on what goods you're talking about. So if you take that mindset that every single year the money that you're making is being devalued, then that means that every year, if you don't get a raise, your salary is worth 3% less. Every year, if you don't put your money into something that earns more than 3% interest for you, then you're not even at par. You're actually losing value that you had the previous year because your purchasing power has changed. And that is the reason that if you go a couple decades without earning any interest, then you're setting yourself up for failure, the future you for failure.
Yeah, no, absolutely. So, okay, we've touched a little bit on savings and what people do to save. And at least for IRAs and, other vehicles other than just like a savings account, there's a lot of employers do like a match program. So that is a little bit of a way to quote unquote invest on your own behalf. But let's talk about traditional investments as well as, alternative investment asset classes and how. First of all, let's just talk about the mere benefits of investing alone.
Yeah, no, I think, the benefits are that you're going to have some decrease of liability on yourself to earn future income if your money is earning future income alongside you. And that's the way that I look at it. That's how I explain it to Ella. When she has, $200 in her box, and I'm like, if you use that money now, it's not going to earn any interest. If that money stays in that box every month, you're going to get an extra $5 or extra whatever percentage we tell her. Because even at this age, like, there aren't a lot of things that she needs, but there's a lot of things that she wants.
Right.
And for her, like, there has to be an incentive to not spend the money every time she has an opportunity to spend the money. Because right now the money is worthless to her because she gets everything that she needs. At a certain point, you're going to need a lot of things and you're going to want a lot of things. And I think that's something that if you look at historical trends, folks that grew up like my dad in the 30s and 40s and 50s saved a lot more money because they went through a time where they might have been a little bit more worried about what their quality of life was going to be, or even if their survival of life.
Absolutely.
Whereas in today's day and age, like, Ella doesn't have to worry about whether she's going to eat every night or whether her family is going to, some families today do, but it all needs to kind of be relative. And I think especially with children and young adults, understanding that if you take some of the delayed gratification, and I know we're in an instant satisfaction kind of world right now, but if you take some of that delayed gratification, you get the benefit of earning interest. And if you can do that all different areas of the risk spectrum, and, if you're an 8-year-old, and you're building a portfolio, which someone's helping an 8-year-old build a portfolio, you're looking at things very long and saying like, okay, like where am I going to put my money? I'm going to put my money somewhere where it might be the infrastructure of the future, because over the next 30 years is going to do very well. Whereas if you're 70 years old, you might be like, I want something that's going to get me a 10 or 15% return. I want to use that cash now. And I might want it to be something that I can give to my kids as some kind of legacy wealth and, as a tax benefits or something that way.
Yeah. So when people first start investing, there's obviously, I think that one thing that you kind of talk about things as if people should know what you're talking about, right? But this episode really is geared towards young professionals or people who fear the idea of investing. So I would take off your professional hat and put on your novice hat when we're talking to us, because one thing that I really want our listeners to understand specifically for this episode is that they have options. There are so many choices when it comes to investing. So traditional investments would include stocks and bonds. They would include ETFs. They would include, what was the last one you just mentioned?
Yeah, you have your traditional equities, which are going to be stocks, mutual funds,
Mutual funds. That would be one these just mentioned. Right.
and then you'll have access to that either through directly investing with those companies, going through a brokerage, or an IRA or 401k, which is tax advantage from the United States government. You also have alternative investments, which could literally be anything that aren't those.
Right.
So a real estate deal like Viking, or you and three of your siblings putting money together to buy a condo and plan to rent it out and have, someone else pay your mortgage. All of that would kind of be classified under alternatives.
Right. There's also now your tech built Bitcoin. There's obviously some other
Cryptocurrencies that, if you truly believe that in the next 50 years, cryptocurrency is going to be the gold standard, then if you have I have investors that they're like, I had a baby, and like, instead of buying them a bunch of gifts, like, I bought them one Bitcoin, and they bought it at like $15,000, and now it's worth $94,000.
Right.
And like, who knows what kind of runway you have on something like that is a new potential currency. So you have lots of options, but traditionally things are going to be kind of dissected into the traditional equities and things that aren't.
Right. And that, that comes with benefits like compounding your wealth. That comes with benefits like passive investing income, right? So you have a way to make a secondary income without the work, which I think is a huge advantage that really needs to be, something people listen to, because I think everyone every day is thinking, how can I make more money? Do I find a second job? Do I start like an Etsy shop? What is the way? Do I do a lemonade stand outside? Like, how am I going to make an extra income because I'm not making enough, or I want to make more? I want to build wealth for my family. And instead of having to work so hard and add all of that extra in, understanding how to make your money work for you is crucial.
Well, and the key thing here, you can kind of think of it like a diet. You can always make more money. And it's something that I live by when when I'm thinking about something. I'm like, I can work harder, I can make more. Just like when you're trying to lose weight, you're like, I can go to the gym 10 times a day. But ultimately, what's going to allow you to build wealth is to spend less. So figuring out what your budget is usually the starting point. So coming up with a list of what I need to survive, what I need to have the quality of life that I'm willing to take right now, and then what's left over. And then if you look at what your income is and 30% is left over, and you take 20% of that and invest it, you take 10% of that and save it, that is something that I think a lot of people utilize in order to build a foundation. And I think that's the right way to go about it.
So there's a strategy called dollar cost averaging. And I don't know that everyone knows about it. Can you kind of dive into that?
Yeah, I mean, the idea behind dollar cost averaging is really, as you're investing along multiple things, and I always look at it like with a risk premium kind of mindset. So you might have something that is a high yield growth stock that pays no dividend. You might have something that has, a really, really risk averse bond with a long duration that pays a 4.5% yield. And you might have a speculative VC investment where you're investing along 20 companies, 2 of them might work out, but the idea is that you might have a unicorn company in there and you're going to 5 or 10x your money. And the dollar cost averaging would be that if you're diversifying across all of these multiple things, some of them are huge swings, some of them are literally butts, where like you're just trying to get on base. It's not even, a true single. The idea of dollar cost averaging is if you build a diversified portfolio in multiple asset classes, in multiple traditional versus alternatives, in multiple areas, then you reduce your risk and you could dollar cost average the yield that you get.
And risk is something, first of all, thank you, because I think that helps people a ton. And I think it's a strategy that I think the phrase is something people will probably hear and have no idea exactly what it means, and maybe make assumptions. So I'm really glad that you clarified that. But I also feel like it's something that people should utilize, especially when they're learning, right? You could go to a financial advisor who will give you a limited amount of options, but they'll still help you diversify your portfolio. And that is one great way to start. But then as you begin your journey and you start really understanding the investment platform, having a strategy in place that you live by, such as dollar cost averaging and having a diversified portfolio, minimizing your risk, but having a high upside. Those things are really, really important when we talk about taking that step in investing and building long-term wealth. Something Chris also mentioned, is they having like a long-term approach. So all of these investments had different time horizons. So knowing where you are and saying, okay, well, I'd really like to have one or two investments in my portfolio that might, become liquid in the next 2 to 3 years. But then maybe the rest of your whole portfolio is 10, 15, 20 years down the road, because the goal would be to build a long-term wealth for your family and set yourself up for success when it's time to stop working, or when it's time for you to have a big purchase or a safety net for your family. And as you continue to do these, the longer that you're in something, the more opportunity you have for it to grow.
Correct. Yep, that's exactly it. And I think that that's the mindset. And if your mindset is, if you're just telling yourself that you're saving, like there's a rainy day fund,
Yeah.
it's the wrong mindset. You're saving to reduce the reliance on like your sweat equity later in life. And, the idea of building wealth for your family, this is how family offices are formed. You have really, really wealthy families who understand like somebody needs to take this family wealth, and make intelligent decisions with it. And we're going to hire people to help structure an office within our family where maybe 4 or 5 families that know each other really well are all kind of offshoots of the same family will pool their money together to put it into really good investments. When you're on a little mini family office and you're 25 years old and you just gotten your first job and you're getting out of college, it isn't too soon for you to start thinking in the same vein. Like, I have this many needs, and everything that I do, every decision I make has an opportunity cost. Am I going to buy the brand new BMW, or am I going to keep that older car that I used through college and take some of that money and invest it and maybe deal with the older car until I can afford to buy one and still have what I want to put away? And you'll see a lot of people blame our education system for not teaching kids finance. And I think that that's kind of spot on, because people, in many cases, it takes people 15, 20, 25 years to realize, like, man, if I would have just put a little bit of money away, not even a large amount, 10% of what I made, enough that where I probably less than I blow on things that I really didn't need or even want, it was just convenience, I'd be in a much better place.
Yeah. Think about how many people go every single day and they spend $6 or $7 on a coffee or like a fast food restaurant, or they go out to an extravagant dinner 1 or 2 times a week just so they can have a date night. But if, let's say, they took a year off from doing that, think about how much money they would have to then put towards not just saving, but investing. And I think one of the things we were talking about, the misconception of you needing to have a ton of money. So maybe can you touch on maybe a couple of platforms you know about, or ways that people can invest with smaller amounts, that they don't have to have $100,000 to start their investment journey?
Are you looking to build sustainable wealth and achieve financial freedom? Viking Capital can help you do just that through multifamily investing. With a team of seasoned real estate experts, Viking Capital conducts deep financial analysis and data-driven asset management to deliver outstanding returns. Their strategy focuses on low-risk opportunities with significant value-add potential, preserving your capital while maximizing long-term growth. Join them and be part of a success story. Viking Capital has acquired 30 properties and manages over 6,000 units, all thanks to their dedicated team and valued investors. Discover their current deal offerings at vikingmultifamily.com and start your journey to financial freedom today.
Yeah, I mean, I think the traditional brokerages, like Vanguard's a good one because it's a really low fee brokerage. The Robinhoods and things like that are getting, Coinbase. These are all getting like really popular with younger investors because it's a little bit more of a tech type platform. Like, even like when I started using Vanguard, I was like, oh my God, this is built for like an ancient person. And even now to this day, like it very much feels like you're working with like a bank from like the 80s or the 90s. It's sub specs. You don't have the same digital and modernization that you have with some of these other platforms. So I've always liked working directly with companies. Like I've mentioned it a few times on this podcast, but when my dad was teaching me how to invest, like we did a lot of direct reinvestment programs, it's called drip programs, where you basically just reach out to a company like Lockheed Martin or GE and you directly go through their investor relations team and you say, okay, I want to be in the drip program, and $50 every week comes out of your checking account and it just goes in there automatically. And you do that for a decade, and before you know it, you have some money in there, and all of the dividends that you would have received get turned into more stock. And that was an easy way for my dad to be like you really can't screw this up. You sign up. That's it. Like you sign up and then it's done, and then you'll forget about it.
You can sign up for Netflix. You can sign up for that.
Correct. Like, and how many subscriptions are you paying for that you don't use anymore? Like if you're subscribing to buying stocks, like that is probably a company in itself.
Right.
So I think, areas like that where it really is just getting out of your comfort zone and kind of learning, using small amounts of money and playing around with it. And in my experience, at least, once I started seeing on a daily basis the values grow, it became more and more interesting.
Right.
Now it becomes opposite of that when you see the value is decrease, because everything that you invest in is going to have risks and there's going to be peaks and valleys. But once you have that first valley, you'll realize that it ebbs and flows. And as long as you aren't short-term speculating, it's very hard to lose over the long term.
And never pull your money out when it is low. Just don't do it. I don't care how scared you are. Just ride out the wave, like let it go, let that valley happen, and then wait for the rise to come back, and then you'll see it. I mean, how many times did we look at our Lockheed Martin in the last decade, and we look at it and we're like, whoa, it's doing great. And then all of a sudden we like checked it up, like, I don't know, like a year later, and all of a sudden it was like, so down.
And there's different examples of that. Like right now, I think a lot of people had little mini heart attacks when all the terrorist news came out and people saw things crater.
Yeah.
A lot of people like reach out to me and they're like, oh my God, look at this incredible buying opportunity.
Right.
And
yeah, with saying buy low.
But there are some companies, like if you were buying Blockbuster stock, buy low, sell high.
Sell high.
Yeah. Or, I mean, there's lots of, Barry Rothschild has his quote, when there's blood in the streets, like that's when you should be, the most active.
Yeah.
And the end of that quote is, even if it's your own, like even if you've lost a lot, this is the time that you should go out there and buy, because this is the best value.
Right.
And I think that that's the approach that I take to investing, is value-based research and investing. But you do need to look out for certain things like technological risk. Like if you were somebody that, bought a ton of shares of Blockbuster in like the 90s, is you didn't think anything could ever disrupt the video rental market. And then Netflix came along, like that was ever going to rebound. So you do want to, like when you're looking at your long-term horizon, factor in as one of your KPIs how easily something would be affected by technology, especially with the influx of AI, because
how quickly it's like moving. It's like more rapid now than it's ever been.
Right. And then there's always like mainstays of a portfolio that I think a lot of sophisticated investors got to go to, is like gold and precious metals.
Yeah.
Something that there's a finite supply of is usually going to retain its value. And the things that are needed in order to get that, like you don't have to just invest in gold, you can invest in gold miners, and those stocks that actually take the gold and rare minerals from the earth. So I think,
what are some platforms, like for this show of purpose, what are some platforms that you would say I trust, or that you would recommend saying for people to start watching to understand the market or understand the investment landscape even more? Obviously our show, but I mean like a true, like a market analysis type situation.
I mean, it depends on the industry that you're looking at, but you can like look through and use your own intelligence to kind of find people that have found lots of success. Mm-hmm. So there's lots of people that have maybe a really large hedge fund, and over the last 50 years, have done really well. and they talk about the things that they read.
And finding those with longevity, not somebody who's like,
Longevity. Like for me, like I love listening to Peter Linneman when I'm looking at real estate, because I know that, he basically built the real estate courses at Wharton. And, someone like that who's been through multiple real estate cycles, when he does his podcast with Willie Walker, like I tune in. I want to hear what he has to say. I don't always agree with him, but I like to hear the way he's looking at it.
Yeah.
There's folks that have managed really big, like Ray Dalio does a really good podcast, a little bit doom and gloom sometimes, but like he's been on point and he talks. And, a lot of these groups that have set up big hedge funds and big investment vehicles, the ones that do podcasts do a really good job of explaining the inner dynamics. So I'm a firm believer that if you study historical trends, you set yourself up for future success.
And having multiple avenues, not just going from one resource, because like you said, it differs from asset class to asset class. It differs from like person to person. Political views also sometimes get in the way. So just having like a wide variety to pull from and then making your own decision, like we talked about in past shows, I think is really, really crucial for people who are beginning that investment landscape and investment journey in their world, and shifting that mindset again to like understanding risks is very important, but you can't solely focus on it. And I think that's what people are like, this, like that fear, that overwhelming fear. I mean, I can tell you, I have that family member who, when we talk about investing, the number one like topic that comes up around is I'm really interested and want to do it, but then fear.
Yeah.
And I just think it's really hard to take that leap when you want to be safe and you have a family and you have all these different things that you're like, well, I'm not really going to lose my money. It may be less valuable, but I still have that as a resource. That I think that transitioning your mindset it's critical for long term, especially when you think about one day your body isn't going to be able to continue doing the things it was doing. It depreciates the same way.
Yeah.
And so like you have to think about that.
Yeah. And I think you should, anyone thinking like, oh, I'm going to invest and I'm never going to lose any money. Like sometimes you're going to lose money.
Right.
But just like when you go and you buy something, you've lost money and you've gotten something for it.
Like buying a car.
If investing always was just automatic and you were guaranteed a return, then everyone would have money and nobody wouldn't have any money. There is going to be some level of risk, but the most successful investors are going to make educated guesses, and they're going to, if they're going to do it, they're going to do it the right way. And that means researching it. That means seeking out knowledge. And that means understanding that there is a cost to learning. And in most cases, it's trying and failing.
Yeah.
And even like I've heard Ray Dalio talk about it. He talks it like he's built one of the biggest hedge funds in the world. He spends most of his time in Singapore and has this big, big company. And he's like, look, I was wrong a lot. And being wrong at those times helped me hone my process and figure out exactly how to set everything up for success and find all the success. And I tell the same people that I mentor on my team at Viking, one of the reasons why, you don't make the most money at the company, and in some cases you're an unpaid intern, is because what I'm giving you is an opportunity to try and fail. And that failure is going to make you smarter and stronger and be able to seek out better opportunities.
I like thinking about it a lot and comparing it to being like a first-time parent. Like, it's so rewarding and exciting, but you're going to make a million mistakes. But most people, once they've done it once, they're like, I'd like to have another one. And then the next time you get better. You already know you have some wins, you have some losses, you understand, and it's never going to be perfect. The child's different, just like the investment might be different on the new one, but you have some techniques, or you have some things you've learned, some strategies for getting them down to sleep at night, right?
Yeah,
like,
that's exactly.
I just think it's a really cool way to think about it, is like, if you're willing to invest in yourself and your family and grow that, then do the same with your money.
Well, you're always going to get more if you are the one putting out the effort. So if you want to have more productivity from your investments, then teach yourself how to do it. Read books, learn how to do it.
Knowledge is power.
If you want to let someone else do it, you hire a financial advisor and you go into their office and they're like, yeah, this is super easy. Put 60% of what you have to invest in stocks and put 40% in bonds. And that's a diversified portfolio. And if you just do that, you're going to be okay. Give me my fee. Like if that's the tack that you want to go, it's probably better than doing nothing, but you're not going to find as much success as somebody that really got obsessed with all the things that they could invest in and wanted to hyper focus on finding the most success.
Yeah, I actually just wrote a blog about the 60-40 split no longer being relevant. And it's funny that you say it that way, because it's just with the volatility in the market, things going on, like that traditional way of creating portfolio is becoming out, like, what's the word for it? Kind of like
It's an outdated model.
outdated, correct. Yeah. And so I think that that's a really important thing to touch on as well. Quick thing that I wanted to ask you about was, I learned about this a couple of years ago. I didn't even know this was a thing, so maybe our listeners don't either. But most people know about a traditional IRA, but there is such thing as a self-directed IRA. So how difficult is it to move your money, if you know? And then why would someone do that?
So it's not difficult at all. It's something that we help folks with at Viking all the time. Typically, a traditional IRA will allow you to invest in traditional equities, stocks, bonds, and they might have an investing platform, they might not. The money's always with a custodian. And the idea would be that if you invest through that IRA, the money that is generated as far as returns goes back to the IRA, and you can reinvest that. Now, what a self-directed IRA allows you to do is it allows you to really invest in whatever you want. So if I had $100,000 in my IRA and I was like, you know what, I'll buy an investment property on the beach and rent it out as a short-term rental, I could do that through a self-directed IRA.
Okay.
If I said, oh, like I like the idea of doing something like that, but I don't want to manage a property, I don't want to be a landlord, I don't want to deal with any of that, you could invest with somebody that's doing that, or you could invest with a big institutional type firm like Viking that buys multifamily as its business thesis.
Right.
And any of the returns that you would typically get by investing with us would now go to your IRA, and they would sit there growing tax-free. So it's an incredibly useful way of weaponizing, we call it weaponizing your IRA to take advantage of alternative investments.
Okay, that's awesome. I hope that's super helpful, because I honestly, until about 2 years ago, I didn't know that was something that you could do. I kind of felt like if you were an IRA, you were stuck. So I like that, that's an alternative for people, and that maybe we can help some people get into something along those lines. And we actually had a really great connection. So feel free to reach out to the show if you need a little bit of guidance on that, because we have somebody we use who is amazing. I really love.
No, exactly. And I mean, the IRA is an interesting product because a lot of times it's the easiest thing because it basically comes with your job.
Right.
Most employers in this day and age offer some type of employee match. So it's very easy to check a box and then look back 10 years from now and be like, oh man, I forgot about this money. Right. It's sitting here growing and look how much it is now.
Right.
Especially if you're a high income earner that makes $300,000 a year and you're maxing out your IRA at like $25,000, $30,000 a year, at least whatever the government limit is. You look back 10 years and you're like, wow, I could buy an investment property with all of this money. So an incredibly powerful tool on the way to grow your wealth more quickly.
Yeah. Well, I think that we have touched on many, many reasons why investing is just more powerful than letting your money sit in a savings account. And I really hope that through this episode, we've helped you to, take that leap of faith and found maybe something that interested you. And you said, you know what, I'm going to take this opportunity to start my investment journey. So I thank you for all your knowledge as usual. And I thank all the listeners for tuning in. We appreciate you, and we couldn't do the show without you. So thank you very much. And we hope you guys have a great one.
Thanks, everybody.
Thank you for tuning into this episode. We truly appreciate your support. Don't forget to subscribe, leave us a review, and share the podcast with your friends. Until next time.